All right, next I'm going to talk about a topic that you've probably heard about, and it's a big component to your ability to qualify for a loan, and that is the debt-to-income ratio, also referred to as DTI. What the debt-to-income ratio is it's basically a look at what money is coming in versus what money is going out, and once again, ensuring that you have the ability to make your monthly obligations. The new mortgage payment, car payments, student loans, credit cards, any other personal debt. And so what we look at with the debt to income ratio is we look at those monthly obligations from your credit, and then we look at your gross monthly income. So that is the before tax income. And this is all on a monthly basis. And so the equation is pretty simple. All of those monthly obligations, including the new mortgage payment, divided by that gross monthly income. And generally speaking, we want to keep that below about 50%. There can be some nuances between loan programs and some flexibilities to go above or some constraints where we have to stay below that, but a good rule of thumb is 50%. Some tips on how to improve your debt to income ratio. One, minimize debt. If there are some credit card balances that could easily be paid off, a small balance on a car loan, you might find that for every $60 of monthly payment that you pay off, roughly, that's going to improve your buying power by about $10,000. Larger loans can have a pretty massive impact on your ability to qualify for more home. And then the last one would be avoid new debt. Definitely while you're going through the pre-approval process, going through the home buying process, avoid taking out any kind of new credit cards, new car loans, because once again, that can massively impact this debt to income ratio and your ability to qualify. The income component, you definitely don't want to start mailing it in at work, take an extra time off that you're not getting paid for, lowering the number of hours worked per week, as that can impact that bottom part of the equation and put a constraint or lower the income that's being used, hurts your ability to qualify for more home. Not that it's easy to wave a magic wand and increase your income, but that is a possibility. Maybe you're in a commission-based role or you get bonuses. Not that you want to perfectly time your home buying search around some of those things, but those components can be factored into the income that we use. If you're getting that bonus, once a year, your buying power is going to be more elevated after you've received that compared to if it hasn't been paid out yet. Another way to increase income and to potentially fix a debt to income ratio problem and improve your buying power would be to look at adding a cosigner. The way a cosigner works is it adds additional income to the application, and now we have multiple people with multiple incomes covering all those combined monthly obligations and the new mortgage payment. And so that could be a great opportunity to elevate that buying power. Keep in mind, that person's income also comes with that person's debt. And so we want to make sure that their debt to income ratio is in line and not necessarily a drag on the overall debt to income ratio. So I hope that helps understand a little bit about DTI or debt to income. If you have more questions or if you'd like to take a look at your personal financial situation in preparation for buying a home, I'd love the opportunity to meet and chat. I'm Mike Stone, licensed loan officer with Megastar Financial, and would love to connect here.